Hi there, today I'm going to share with you how you can buy 5 properties in 5 years and really exponentially grow your property portfolio. Now, I know there's so many strategies out there. So many people say you should do this or that, rooming houses, you should do your residential flips or maybe the granny flat at the back or maybe NDIS housing. But really, the true answer is commercial property. Now, how is it commercial property? Why is it a commercial property? And why is it in 5 years you can accumulate 5 properties? And how is that going to affect you in cash flow? And how much deposit do you need to get started? And how fast can you grow? Now, that's a lot of questions, but I'm going to answer them for you in this video. My name is Helen Tarrant. I help everyday Australians become wealthy and retire sooner through commercial property, and it's done with strategy so they know there's a step-by-step way, and we build it through a team behind you supporting you through that process, because together we can achieve wealth together, right? So let's get started. So how much money do you need to get started if you want to grow to 5 commercial properties in 5 years? Now, you'll need about $200,000 to $250,000 at minimum to get started. Maybe about $200K on the lower end, $250 to give yourself a buffer, but that is the minimum. And I've recently done a deal like that in the ACT, and I've seen my clients, my students repeat this in other parts of Australia. So maybe in regional Queensland, regional Victoria. So it's definitely a strategy that's replicable across Australia. But if you do get it wrong, it does cost you thousands of dollars to rectify. So make sure you listen to this video from beginning to end so that you fully understand how the strategy works. So number one is that if you have $200,000 or $250 with a little bit of buffer, right, then you could get started with buying a $500,000 property. Now that $500,000 property is going to be a vacant property. So the market is scared of doing vacant properties, right? Because I just want something tenanted. But in real fact, look at the current market at the moment. If you buy a tenanted property, you're best going to get 6% in a metro area like ACT, 7% in regional areas. And with the interest rate already hitting close to 7%, you're barely breaking even, maybe getting $2,500 or $10,000 in cash flow. And if you're buying a residential property, forget about the cash flow. You're getting no cash flow at all. You're putting money out of your own pocket into it. But if you're always thinking about development, maybe I should develop in residential, that's wrong again. Why is it wrong? It's wrong because by the time you pay for land, the value of land has gone up, the building cost has gone up, the price of tradespeople have gone up, you're making no margins. In fact, you're actually in the red. So you're actually paying out money because people aren't paying the same high amount of money for ready builds than they did back a couple of years ago. So that means we're at this frictionless point where you can't move forward with your portfolio. You have to find a strategy, and the only strategy is commercial, because right now this has been tried and tried in the last couple of years through the Unikorn company and with our clients, that if you buy a vacant property and you need to do your research, and I'll do that in another video, but if when you do your research, you are going to need to find a property that is in a nice area, got plenty of demand. It's going to be a vacant property around $500K, and you're going to need a no doc loan. So you're either going to be able to service the loan because you're young and starting out and you've got plenty of serviceability, or you're going to need no doc loan. No doc loan is going to be expensive. It's going to be 9 or 10% in terms of the interest rate, but that's all part of the holding cost. So to get a property at $500K, you're going to need about $150, $170 in terms of your deposit in. Now you've got a holding cost, and that's why you've got your extra $50 or $30K as your holding cost. And of course, then you've got that out of there, you're going to be using that money for marketing. And if you can add in a little bit more buffer than $200K, you're going to have money to give your tenant for rental incentives as well as rent-free period. Now the whole idea is you get a tenant in, you get them sign a brand new lease, and now the property's worth, instead of $500, is worth $700,000, right? So when you sell the property, and you have to sell it the first time because you're trying to trade up and bulk up your deposit, right? And you sell it for the first time, you're going to be able to get $700K, pay out some commissions to the bank. And remember, depending on the different entities you're holding it, you're going to have different tax concessions. Then you probably end up with $150,000, maybe $130,000 to $150,000 in your hand. So now you've changed your $200 to $250 to $1, and you've added in another $130,000 to $150,000. So now you're almost at $400K, which is fantastic, right? Now you can go and do a bigger deal. So the next deal you do is you're going to do a deal that is potentially $700,000 or $900,000. The same thing repeats. You add an extra $200 to $250K to your deposit or bottom line at the end of every deal. How do you get 5 commercial properties in 5 years? Well, when you get to your second flip, you want to be able to refinance, keep that one, take out the money and go again, right? You want to get to a pattern where you're actually doing one every 6 to 9 months. months. And that means the last 4 years, you might have spent 1 year doing the first one, but you can get 2 in the second year, but keeping 1 and getting into the second one. So you refinance the first one and pull out that money, do again the second one. So you're on a bit of a rotation, right? And so this way, you're bulking up your deposit as you go along. You may need to flick and sell someone in between that 4-year period because you want to bulk up your deposit, go again. But ultimately, whether you're holding on your small one or you're getting a large one, you are going to be able to accumulate 5 commercial properties over those 5-year period. But the first one is really key. Get it right, you can continue to do it. Get it wrong, the plan is gone, right? And that's why it's so important to have a team behind you to deal with people who totally understand what you're trying to achieve. And that's not just trigger happy, let's just go, not looking at the market, not comparing and benchmarking around the market, which a lot of other people who are educators, buyers agents do, but really understanding you and what you want to achieve, joining a company who can support you and create wealth with you together, right? And that's what we do here at Unikorn Commercial Property. Check us out, helentarrant.com, unikorn.com.au, booking your strategy course so you can see if this strategy really works for you. But truly, with 200, 250,000, you can actually get started and continue to build your commercial property portfolio. And the thing is, once you build it, you also have cash flow, right? So if you're buying a $500,000 property, you're going to have cash flow, and the returns you're going to get are going to be 1.5% higher than the market. So you can choose to keep it or you can choose it to sell it, right? But if you choose to keep it, you're getting more cash flow, which helps you to service the next deal, which means that the next deal, maybe by your 3rd deal or your 4th deal, you actually then have enough cash flow to not go for these no-doc loans. So your interest rate's going to drop by 3%, because see, if you are able to service a loan, the interest rate's probably 6.5% at the moment. If you're not, it's 9.5 to 10, right? So that 3% can be more money in your pocket, right? And it's all about growing that wealth together. So by the time you get your 3rd property, and we can map this out for you here at Unikorn, is when you get to your 3rd property, you want to be able to retain them, you want to be able to pull the cash out, but also you'll be able to have some cash flow going forward. And that's cash flow, like even on just keeping. If you kept your first one, which is 500K, right? And you're able to get a tenant, the tenant's going to be paying you around $40,000 net income on a $500,000 purchase. That's like an 8% return, which you don't get in the market, not even in regional right now, unless you go to a mining town, which is high risk, but you're getting that in metro. And your interest rate somewhere is 6.5, so you're clearing that 1.5% margin. So what does that mean? That means you're getting somewhere between $7,000 to $8,000 in cash flow from buying into a $500,000 property, which you wouldn't in normal life when you go out and buy just a tenanted property. That's why this strategy is so powerful, and this is how you can piggyback off each other to continuously grow your portfolio. So 5 properties in 5 years, absolutely achievable, but you've got to have a plan, got to have people behind you, got to give you the right blueprint to move forward. So in order to do that, click below, looking for that strategy call, and I'll see you on the other side.